Good afternoon, everybody, and thank you for joining us today for this month's tax investigation presentation. My name is Dave Jennings, and I'm here with my colleague Dane Skiba. Thank you for joining us again. If you're regular watchers, if you're watching this afresh on the recording, or if you're joining us today, that's fantastic. Just a brief introduction. I'm an ex-HMRC Inspector of Taxes. I spent nearly 20 years in the Revenue Customs, undertaking various investigations of businesses and individuals, and I'm a qualified chartered tax advisor as well. I left HMRC when headhunted in 2006, and since then I've worked for a number of top 10 firms of accountants and specialists in the tax investigations disclosure arena. So I've used my 30-odd years experience to help clients facing inquiries and making disclosures. And today we are going to deal with disclosures. I'll let Dane briefly introduce himself, and then I'll start today's webinar.
Thanks, Dave. Yeah, my name's Dane. Similar to Dave, I had a background training as an inspector at HMRC. Haven't quite been in tax as long as Dave. I've been in about 10 years now, and I left HMRC in 2018. Went to one of the big six accountants in Grant Thornton, and recently joined Churchill's earlier this year.
Brilliant, thank you. So let's start the presentation today. We've done the introductions. We're a full service practice. We do all accounting and tax, but our specialist services of tax investigations we provide to other accountants who need that specialist to work alongside them, or solicitors, IFAs we work with as well. Well, obviously, we are not interested in taking clients from other accountants. We like to work alongside them and do as much or as little as the accountant may require, but they do need specialist services. And today is one of those specialist services we provide both to other advisors for their clients and also to clients who approach us direct. And that's to do with the worldwide disclosure facility, which is declaring offshore income that maybe, for whatever reasons, has not previously been included in tax returns or notified to HMRC. It's one of a number of existing campaigns that are available for taxpayers and clients. The other ones are let property, which if you've not declared historical income from property that's been let as a landlord, or income from selling the property as a capital gain, then that facility is available, and we deal with lots and lots of clients with that as well. If it's non-sector specific, such as offshore or property, there is the general digital disclosure facility, which is a sort of catch-up disclosure scenario. And then for VAT, there's a separate one because these disclosures don't cover VAT. That has to be dealt with under a separate route. And for the more serious ones, which we covered on the previous webinar, and that's where fraud is either alleged by HMRC or is being volunteered, holding your hand up that you've committed fraud, deliberate behaviour, that's tax evasion, that's the Code of Practice 9. If you require any advice or help for any of these disclosures or inquiries by HMRC, then please do get in touch with us. So today we're going to cover the worldwide disclosure facility, and similar to the let property one as well, this all has come about through information that HMRC has had over the years, and they do risk assessments, risk reviews of non-paying taxpayers for this income that's maybe not previously been disclosed, and they issue what's known as a gentle nudge letter if they haven't opened a full-blown investigation or inquiry. So what these letters say is, please check your tax affairs. We have information that we believe your tax returns have maybe been incorrect in the past, or it may be a question that we don't have any tax returns from you, but we have information that suggests you should have made tax returns, and therefore they're giving you the option to make the disclosure before HMRC open an inquiry. This is still a prompted inquiry by HMRC, even if it's not a formal inquiry, and Dane will cover that in a minute. But certainly you shouldn't ignore these letters. It doesn't mean that tax is payable. There may be scenarios where tax has already been paid overseas, for instance. There may be the situation for property where there's no profit been made However, a disclosure is still required, and you ignore them at your peril because you will face an investigation in due course by HMRC. So specifically to do with the offshore income, since 2017, with various agreements worldwide, the Common Reporting Standard, offshore countries send financial information. They're required to send financial information to the UK, and the UK responds in like. They send information for UK accounts, UK assets, property, investments, information that financial institutes have in the UK that they're obliged to send to HMRC. HMRC pass that information to the foreign countries. Their own equivalent of HMRC will then open inquiries in those countries. The reverse happens here. We receive information from various countries, over 100 signed up to the CRS system. So you can imagine the amount of information on HMRC's database. We've seen accounts and alleged accounts and nudges regarding some of these countries such as India and Hong Kong, America, Ireland and France. So Europe, America and Asia seem to be the majority of information we are seeing, but it could be any of these 100 countries, and HMRC are frequently issuing these nudge letters. So what happens if you've had a nudge letter, Dane?
Yeah, thanks, Dave. So, I mean, generally, disclosures fall into two categories, and that could be prompted or unprompted. Prompted is when HMRC make the first move, as Dave mentioned with the nudge letters. If that's the first interaction you've had with HMRC, that would be deemed to be a prompted disclosure if the disclosure is then made afterwards. Unprompted is generally when you take action before HMRC have done anything. The definition within the HMRC guidance states that a disclosure is unprompted if it's made at a time when the person making it has no reason to believe that HMRC have discovered or are about to discover the inaccuracy, underassessment, failure to notify, or deliberate withholding of information. Otherwise, it's prompted. I mean, the importance of whether a disclosure is prompted or unprompted comes down to the penalty percentage that would apply. Any tax liability that is calculated as part of a disclosure, the penalty percentages the penalties are tax geared, so a percentage would apply to that. If it's prompted, the ranges are higher, which we'll come on to in a few slides' time. When you register a disclosure with HMRC, if you were to do it kind of voluntarily, you'd make the first move. If you were to register that disclosure, you generally get 90 days in which to calculate any liabilities and finalise the disclosure. If after that you were to receive a nudge letter, you're kind of protected. You've got that first move in, so you would still fall within that unprompted category when looking at the penalty percentages. And in regards to the kind of ongoing tranches there, I mean, there's numerous campaigns that HMRC run, and they receive information from various jurisdictions at various times to try and tackle this offshore non-compliance, as Dave mentioned with the CRS, the Common Reporting Standards. Me personally, in the last couple of months, I've seen a lot to do with offshore property in Italy, France, Spain, and also they've raised a few in investment income in India as well. So they'll be continuing to kind of release these tranches as they get that information to try and tackle this offshore non-compliance. Thanks, Dave. Next slide. Just put this one on for a bit of a recap. This is just the general HMRC assessing time limits. So as you can see there, there's two assessing time limits, and they kind of link into the penalty percentages as well. Two categories there. One where there's an inaccuracy, that's where there's been a tax return filed that doesn't contain all of the correct information and there's an inaccuracy. And then there's failure to notify, and that would be where you haven't filed a tax return, but you maybe had an obligation to file one. Where reasonable care has been taken for an inaccurate return, you can see that it's the maximum amount of time HMRC can go back is 4 years. Where there's been a careless inaccuracy, it's 6 years, and deliberate is 20. For failure to notify, it's a little bit harsher. Where reasonable care has been taken, it's still 4 years, but there's no differentiation between careless and deliberate, meaning that HMRC can go back 20 years. This feels particularly harsh, and a lot of clients that we've been making disclosures on behalf of, they receive a nudge letter from HMRC. They might have offshore property in which they've paid tax in the foreign country. They might be an employee in the UK, so don't file any kind of tax return. Therefore, don't really have the need to have a financial advisor. therefore aren't aware of their obligation. So they receive a nudge letter. That's the first time they're aware that there might be a UK tax obligation, and then they kind of seek professional assistance. In which case, the time limit there could be 20 years. So it can be a little bit harsher. But that's a recap of the normal time limits, and we'll just come on to the extended ones for offshore. So the extended time limits, these are introduced from the 6th of April 2021, and this essentially extends the time limits for reasonable care and careless inaccuracy, so the 4 and 6 year time limits, up to 12 years, meaning HMRC can go back 12 years from the from the year in which they're making their assessments. Doesn't affect the deliberate assessing time limits. That's 20 years regardless, so there's no extension there. The earliest years this can impact, you can see on that table there, is 2013-14, and that would be for the careless inaccuracies. For the reasonable care ones, that 4 year time limit is expired anyway. You can see there the first year in which the extended time limits affect the reasonable care is 2015-16. One key thing to note, I mean, this is obviously giving HMRC a wider window of opportunity in which to raise assessments where there's been offshore income that hasn't been correctly declared. One thing to note is that the extended time limits wouldn't apply if HMRC, within that 4 or 6 year, dependent on behaviour time limit, if they've received information under the common reporting standards from that offshore jurisdiction, and they could have reasonably been expected to be aware of that loss of tax and raise an assessment within that time limit, within that 4 or 6 year time limit, but they don't, the 12 year time limit wouldn't apply. It doesn't just automatically apply to everything. So that's quite a key one to be aware of. I think that's it pretty much, Dave, unless you've got any comments on that.
Yeah, no, thank you, Dave. The reason for bringing this up to date with the changes in April 2021 is that pre-April 2021, the requirement to correct time limits applied, and that was again specifically around offshore income, and the new legislation that came in place in 2017 said that if the Revenue could issue an assessment in 2017, they had until April 2021 to collect that. So the earliest year the Revenue can go back on carelessness in 2017 was 2010-11. So up until April 2021, the WDFs for inaccuracies would have gone back to 2010-11. So there's been quite a big change since April. The number of years have been restricted back to 13-14 for carelessness. Prior to that, it was earlier than that. As Dane's mentioned, though, if it's deliberate, it's still 20 years. If it's a failure to notify, so you've never completed a tax return, it's 20 years. So it's always the worst of. And these extra extended time limits, which extend from the 4 to 6 up to 12 years, is specifically for offshore income only. There is also a strict criminal liability penalty as well, potentially for offshore income and failing to disclose offshore income. We're not that's not part of today's webinar, but it's just indicative that there are other penalties HMRC can also apply for failing to disclose offshore income, and there is also potentially an asset-based penalty too, and potentially even naming and shaming on penalties. And talking about penalties, they are very, very draconian for offshore income. So the failure to correct penalties, which was linked to the requirement to correct legislation which came in 2017, that as sort of more historical anyway, but it does show here with this table that the minimum for, even if you make an unprompted voluntary disclosure, the minimum penalty can be 100% of the potentially lost revenue. So PLR is potential lost revenue. So the new tax that's due can be a minimum of 100%, even if it's a voluntary disclosure for offshore income, up to and including the tax years 2015-16, and go right up to 200%. If it's a prompted, so if you got a nudge letter, you're already in a minimum of 150% penalty. Obviously, with our assistance, you can ensure that you get that reduction down from 200% maximum down to either of those minimums. It's important to cooperate with HMRC, stick to the deadlines, provide the full information. The WDF is self-assessing it with obviously the expertise. You need to make sure you don't get it wrong, otherwise you can then face the bigger penalties. In addition to that, so what happens after 15-16? Well, for tax years 16-17 and later, the penalties for offshore income fall into a number of categories. These are internationally recognised categories, and the normal category is category 1, which is the UK and Europe, America, and many other countries that are deemed to be compliant with sharing information to HMRC and historically sharing information to HMRC. So you've got the standard penalty scenario, which ranges in categories between 0 and 100, depending on the behaviours of carelessness or deliberate, which Dane touched on with the number of years the revenue can go back. Those behaviours affect the penalties as well. So there's a range, which we're not going into specifics, but if you make a voluntary disclosure unprompted, there is a potential for 0 penalty. If you have a nudge letter from HMRC or an inquiry that's been opened, the minimums depend on the category which the country falls into. So if it's the UK, it would have been 15%. If it's Europe, it's 15% minimum on a nudge letter. India, for instance, falls into category 2. Category 3, it tends to be the tax haven categories. Cayman Islands, for instance, is going to be, I think, still category 3. They do move up and down categories depending on compliance with sharing information to the other countries, and some countries have changed from category 3 to category 2 or category 2 to category 3 as they comply with international rules on sharing information. Otherwise, general penalties for failure to notify are slightly different. And again, this is for 16-17 onwards. If it's unprompted, then the penalties for failure to notify can be a minimum of 10%, up to 20%, depending which country it falls into. If it's been a prompted inquiry, failure to notify, your minimum penalty goes from 20 to 40. But as mentioned in the earlier slide, the maximum penalties can be 200% if it's a category 3 country. So it's important to ensure that you get mitigation against these penalties. The worst case scenario is those maximums. The best case scenario is the minimum. Depends on behaviour. It depends on how the inquiry or how the disclosure is operated with HMRC to ensure you get those minimum penalties. Thank you, Dane. I think you're going to wrap up on some pointers we've seen in the cases we've had over the years, and that we've dealt with some of the common themes here.
Yeah, so I mean, Dave just mentioned some of those years that apply to the failure to correct penalties, and how harsh they are really is probably the fairest way. There's no differentiation between careless and deliberate like there are with the normal penalty percentages. So the careless penalty, the minimum ranges are 100 if it's unprompted and 150 where it's prompted. So they're significant penalties. The only time that a penalty wouldn't apply under failure to correct is if there's a reasonable excuse. And that would be specific to each taxpayer. HMRC have to consider all of the facts on their own merits, and each case will have all of their separate nuances. So reasonable excuse can get you off that penalty, but it will be specific to the facts of that case. The second point there, voluntary disclosure. I mean, the penalty, there is no differentiation between careless and deliberate. It is extremely harsh, and the only way you can reduce that penalty is where you can demonstrate a reasonable excuse. The prompted, and then the final point there, I think I mentioned what we see a lot of is people that are employed in the UK. So they might have, be of Spanish domicile, move to the UK, have a rental property in Spain, be employed in the UK, have no need to file tax returns. They're the ones that seem to get caught up in this because they're not aware of their UK obligations. Now, these nudge letters do kind of get them in order to put things correct, and we can certainly assist with that. The foreign tax, we'll put there about the foreign tax credit. The fact that you've paid tax offshore doesn't mean that you don't have a UK filing obligation. Even if that foreign tax credit does reduce your UK liability to nil, you still have to report that income in the UK. So it's important. Through that nudge letter, you might not have a tax liability, but you still need to kind of respond to that and explain why there might not be a UK tax liability.
Yes, that is an important point, Dane. Well mentioned there. That sometimes people think that all the tax has been paid and therefore there is no requirement to respond maybe to the nudge letter, but there is. It may be that when looking at the analysis, when checking the figures, there is no tax to pay. That's fine. We can submit nil disclosures. We can send reports to HMRC to say there's no extra tax. It depends on a case by case. Equally, we have helped clients in some scenarios where there have been genuine reasonable excuses and penalties have been reduced substantially, or potentially even to zero. But obviously, that's few and far between where they're going to fall into that category. But we can help them. Sorry, lost my screen there for a second. Still connected. So in summary, what we would say is obviously come forward before you get a nudge letter or an inquiry, because that can massively reduce your penalties. We've just seen the different rates. You can save sometimes a 50% penalty, and that's a penalty based on the tax that's due. So if you pay £100 of tax, you can end up with a £150 penalty if you wait till the revenue is you a nudge letter or an inquiry, or even worse, £200 penalty. Whereas if you approach the revenue voluntarily, then you may end up with just a £100 penalty, which is still substantial, but better than 150 if you've got £100 of tax. Obviously, for some of the later years, the penalties do reduce down, but it's crucial to come forward sooner rather than later. But if you do get a nudge letter, again, don't wait, don't ignore it. The revenue open investigation is going to increase your penalties, increases your stress. Let's sort things out. Let's deal with it. Do approach a specialist. There are pitfalls of getting it wrong. You want to get it right first time. Sometimes with a disclosure, HMRC may still make some questions. It is quite common for the revenue to ask a couple of questions about where did this come from, or explain this particular calculation, or justify your penalty, for instance. They may sometimes ask those questions, and they're quite within their right to do so. But many of our disclosures that we make under WDF are accepted in full without any queries from HMRC. Do contact us if you need any help with the WDF or offshore income that you've not previously disclosed, or get an inquiry from HMRC. Contact us here at Churchill Tax Advisors, myself or Dane, or contact our direct switchboard. Look us up on LinkedIn, look us up on the website. Thank you very much for attending us today. Was there anything else you wanted to wrap up there, Dane? Any other points?
No, I don't think so. Thanks, Dave.
Cool, brilliant. Thank you very much, everyone, for watching this today, or watching the recording if you're watching it later than the 10th of August. Thank you for doing that. Please join us again next month when we'll cover another topic which is specific to investigations or disclosures. Join my colleagues in a couple of weeks' time, who will be giving a webinar on tax and advice, or a particular tax subject. Please watch that one. Look out for it as well. Otherwise, enjoy the rest of your time or day. Thank you very much for joining us. Goodbye.
Cheers. Thanks.